Welcome to lesson number 35, Chart Patterns with Real Movement, and specifically today's topic Fakeouts and Liquidity grabs on real chart movement. I'm your lead educator at Trading Club 7U. As traders, we often encounter situations where the market seems to be moving in one direction, and we think we have a clear setup, only to be surprised by a sharp reversal. This can be disheartening and confusing, especially for an absolute beginner in trading. But today, we're going to break down what causes these fakeouts and how we can spot them using simple and clear explanations. Let me start with an analogy. Imagine you're at a busy shopping mall, and the crowd is moving towards the food court. As you join the crowd, you see people rushing in a particular direction, and you think you know where everyone's going. But suddenly, someone shouts sale, and everyone turns around and rushes in the opposite direction. This is similar to fakeouts in the market. Prices can move in one direction due to the collective behavior of many traders, and we get caught up in that momentum. But then, something unexpected happens. A new piece of information comes out, or a big player suddenly enters the market, and the whole dynamic changes. In the context of trading, fakeouts occur when a large order or a cluster of orders is absorbed rapidly by the market, creating a misleading appearance that prices will continue in a specific direction. This can cause traders to enter positions prematurely, only to be surprised by a sudden reversal. To understand this better, let's look at a simple example. Suppose we're trading a currency pair like euros, and we see prices moving up sharply. We think the trend is up, and we enter a long position. But then, a big player suddenly sells a large amount of euro, causing the price to drop rapidly. For instance, imagine the euros chart is showing a strong uptrend, and the price just made a new high at 1.10. As the price touches this level, you expect the trend to continue, and you enter a long position. However, if a large sell order is placed and absorbed quickly, the price drops to 1.08, leaving you with a loss. This is an example of a fakeout. The key to spotting fakeouts is to look for large price movements without a corresponding shift in liquidity. Liquidity is essentially the ease with which we can buy or sell a security quickly and at a fair price. When liquidity is low, even small orders can cause large price movements. For instance, if we're observing the euros chart, and we see a large price movement in a relatively short period of time, we should question whether the market is really moving in that direction, or if it's just a fakeout. One way to determine this is to check the volume and order flow patterns. A high volume, high order activity suggests that the price movement is genuine. However, if the volume and order flow are low, it could be a fakeout. Another way to spot fakeouts is to look at the chart patterns. A sharp price movement without a corresponding shift in the chart pattern, such as a continuation of the trend, can be a sign of a fakeout. Common beginner mistakes include getting caught up in the excitement of a trend and not paying attention to changing market conditions. This can lead to premature entry or exit, resulting in losses. Another mistake is failing to consider multiple scenarios, including potential fakeouts. To exercise caution, we should never enter a trade without considering multiple scenarios, including potential fakeouts. One way to do this is to focus on the areas with high liquidity, such as the daily high or low, where large orders are more likely to be absorbed. For your practical homework, I want you to open a demo chart of euros and identify areas of high liquidity, such as around the daily highs and lows. Observe the price movements and see if you can spot any fakeouts occurring. Take note of the order flow and volume patterns. For example, let's say you're observing the euros chart, and you notice a price movement in a narrow range between 1.08 and 1.10. This is a relatively high liquidity area, and large orders are more likely to be absorbed in this vicinity. If you see a sharp price movement in this area, without a corresponding shift in the chart pattern, it could be a sign of a fakeout. As you continue your trading journey, remember that fakeouts are an inevitable part of the market. The key is to stay alert and adapt to changing conditions. Practice makes perfect, so be sure to practice fakeout recognition on a demo chart before trading with real capital. To take your fakeout recognition to the next level, try to identify the type of market that's most prone to fakeouts. Is it a breakout market, where large orders are pushing prices outside the normal range? Or is it a continuation market, where traders are following the established trend? Understanding the